and introduce our keynote speaker for the day, Dr. Ryan Clements, the University of Calgary. He's the chair of Business Law and Regulation, who will be talking about crypto innovation and the regulatory path forward. I'd like to pass it over to you, Ryan. Over to you.
Thank you, Craig. It's a real honor to be here with you. As mentioned, I teach and write extensively in fintech and crypto. I've written a variety of articles. You can find all of my articles on my website, ryanclements.com. I've published on things from DeFi regulation in Canada to crypto stablecoins, algorithmic stablecoins. I also took the pen on the expert report on crypto governance for the Public Order Emergency Commission that recently finished. So you can also find that on my website. I will reference some of these works in some of the thoughts that I share with you today. Just by way of kind of caveat, I do serve on several regulatory committees. So I'm on the New Economy Advisory Committee, the Alberta Securities Commission, and I'm also on the National Investor Advisory Panel of the Canadian Securities Administrators. So anything I say today is mine, my own thoughts, and do not represent any of those committees. So I have some goals today. I hope it to be engaging, accessible, thought-provoking. I want to contrast the kind of underpinning ethos of crypto to what we have seen starting in May of 2022 and working its way up through the winter, and look at how regulation plays into this. So what are the underlying policy objectives of regulation? Not just in crypto, but across financial markets. What are some of the historical situations that regulators are looking to respond to, and how does that apply into the crypto ecosystem as we see it today? What are some of the tensions that we have when it comes to regulation, and how do we work through some of those tensions so that we can ensure an innovation forward and progressive economy, but still satisfy various policy objectives that regulators have? And this is not just securities regulators, but prudential regulators as well. Within the banking framework. So I hope some of my thoughts in this regard are thought-provoking, and as I mentioned, you can read more about some of my published work on my website, and feel free to reach out to me. Contact information is on my website. Well, let's start here. For many of us, I suspect, who are listening in, there's certain ideas, themes, philosophies, if you will, that are compelling, that attracted us initially into crypto, period, and into blockchain. And I've thrown a few on here. You hear these often cited. There's themes that you can see in Satoshi's early writings, some of the early writings and current writings of Vitalik, the white papers of a variety of innovations across the crypto and DeFi ecosystem. We'll talk about things like disintermediation, decentralization, censorship resistance, social scalability. Those of you who are familiar with the writings of Nick Szabo, for example, and peer-to-peer ecosystems. And I would argue that these are still compelling. I think the evidence that these are still compelling is the current movement in crypto markets over the last 10 days. If you look in response to traditional bank failures, poor duration mismatch and duration risk management, several banks have actually, we've seen some traditional bank failures, and we've seen a significant increase in, for example, the price of Bitcoin, and today the price of XRP. I think that represents that these ideas are compelling to a lot of people. When we see bad intermediation, if we want to call that, whether it be bad duration risk management, bad risk management period, or bad governance, the idea of decentralized ecosystems and the ability to interact in terms of value transfer or in terms of any financial product or service, conceptually, the idea is compelling. Well, we know from the literature that there's a whole bunch of things that blockchain could have potential utility for. I've intentionally thrown a whole bunch, which I'm not going to get into any of these, but those of us who are familiar with the literature know that there's conceptual and real utility and use functions for blockchain technology. So it was interesting when Vitalik gave his interview on April 4th to Time Magazine. If you haven't read this, I would encourage you to read it. That was quite interesting, where Vitalik identified some of the concerns in not the ethos of crypto or the underlying sentiment or I guess motivation behind building within the crypto ecosystem, but rather in how the market had evolved, which takes us into really some of the regulatory impetus and the steps taken by global regulators to date in the crypto ecosystem. Because while we can think about disintermediation, decentralization, peer-to-peer ecosystems, there's large portions of the crypto ecosystem that shows significant intermediation, custodial functions, concentration risk, things that seem to be antithetical to the underlying ethos of crypto. And we can even take it a step further, and we can see, particularly in the events starting in early May 2022, I would suggest Terra being the catalyst to a series of other contagion events where, again, we can see intermediation, we can see concentration, we can see perhaps asymmetries and maybe potentially the replication of pathologies that we've seen in traditional finance. We look across this slide and we can see Celsius. Banks are not your friends. Well, Celsius was performing liquidity transformation too. We can see Terra that was suggesting a decentralized ecosystem completely, but the SEC enforcement action that dropped several weeks ago shows actually significant centralization, significant central orchestrated maneuvering. We can see FTX designed around this idea, the ethos of crypto, disintermediation, peer-to-peer ecosystems, social scalability, censorship resistance, yet performing a custodial operation that was facilitating margin and leverage collateralized with bad risk management, bad governance, and fraud we've seen. I can go on and on and on this. Does this mean that blockchain has no utility? No, that doesn't mean that at all. Well, what does it mean? What it means is that we have seen the entrance of certain actors that have had an impact on other actors within the crypto ecosystem. And we can see in relation to the actions of certain actors, now the regulators looking at this saying, okay, we have things in this space that even though the space is supposed to be different than the traditional space, we have things now in this space that look like the traditional space. We have certain trends too with respect to blockchain I would say frictions and risks. It hasn't been obvious that self-custody is something that a lot of people want. It seems like moving over into having someone else custody your crypto assets seems to dominate the market share. It seems to be that the idea of interfacing directly in code is a scary proposition. Some would even argue a might equals right kind of marketplace. And those of you familiar with the index finance case can see that highlighted quite easily, where if I go into a certain DeFi ecosystem, I better ensure that the asymmetries are in my favor. Some have suggested that maybe that's historically the value of intermediation. And maybe that's why crypto has trended towards custody and trended towards intermediation, because gatekeepers provide some type of a stability function. Now, in addition, it's challenging to integrate certain types of, at least to date, and maybe this is just a technological issue that we'll overcome in the future, but it's been challenging to implement certain types of contracts into smart contract functionality. And the idea of permission blockchains has issues as well. So that's impacted kind of the evolution of the market, if you will. So, for example, when we look at regulatory steps to date, we can see many of these regulatory steps are in relation to or in response to pathologies that have appeared in our experience in crypto to date. So if you look at the enhanced pre-registration undertaking, for example, CSA Staff Notice 21332, which just came out, we can see enhanced controls around security and custody. We can see the inability to use proprietary tokens. We can see a lack of margin, credit, or leverage, but it's easy to point at these and say, well, that was directly driven by pathologies that we've seen, for example, in FTX or in Celsius, okay, BlockFi, etc., Voyager. But those are not in relation to the blockchain technology. Those are not even in relation to the ethos underlying crypto. Those are in relation to the replication of pathologies within the crypto ecosystem that are familiar. They're pathologies that we've seen for hundreds of years in financial markets and responding in relation to protection of those pathologies that have integrated into the crypto ecosystem. And there's more too. We've seen lots of stuff, fraud, insider trading. We've seen reliance on marketplace and difficulties with respect to that. We've seen systemic risk and interconnection, okay? You don't have to go far to look at how the price of Bitcoin was affected when Terra failed. Price of Bitcoin was affected when FTX was failed. We can see interlinks. We can see asymmetries, inadequate disclosures, market manipulation, cybersecurity issues, shadow banking, liquidity transformation. Does this mean that crypto has no value? No, that's not what it means at all. Does it mean that there's no utility? No, that's not what it means at all. It does mean, though, however, that we have seen the market evolve in a way where familiar pathologies have integrated into the crypto ecosystem, at least the way that retail investors are interfacing into the crypto ecosystem. So when regulators look at this, what do they think about? What are the underlying policy goals and frameworks? Well, there's a number of policy objectives. Now, this is just in securities. This covers all of financial market regulation. So things like financial stability and safety and soundness of key institutions, ensuring market fairness and promoting efficiency. And you can also see regulators move in response to historical and fundamental realities, such as an asymmetry between promoters and investors, a lack of adequate market incentives for disclosures that are accurate, that don't include misrepresentations, inadequate market incentives to design sufficient internal controls and systems, and inadequate internal and market incentives to design sufficient risk management and governance measures. And the regulator hopes for a resulting impact of confidence and trust alongside economic efficiency, growth, lowering bargain costs, ensuring clear avenues of accountability and liability, and recourse remedies and redress. That's the goal. Well, what happens when you don't have any of it? Well, we've unfortunately seen some of this in DeFi, and I think the best example to date is with Terra. If we start with Terra, for example, I've written a lot on Terra. I published a piece called Built to Fail, where I attacked the underlying premise of algorithmic stablecoins in October of 2021, while Terra was on its run. And I have an entire subsection on Terra that I made particular arguments that I thought that algorithmic stablecoins, these being entirely uncollateralized algorithmic stablecoins, are fragile. Well, Terra in response built a quite elaborate financial architecture utilizing an anchor protocol, which was a lending facility that created an unsustainable return that was propped up by centralized actors in the Terra ecosystem. And when it all failed, when there was a run against the anchor protocol, it affected the depegging of UST, which torched the value of Luna in a death spiral, something that I talked about in my paper. The challenge was, Luna was available on a lot of crypto asset trading platforms in Canada. despite undertakings not to trade securities, that crypto assets that were securities on their own. Now, we've seen SEC enforcement action has come out against Terra and Dogecoin in particular, not just identifying that Luna was a security and UST was a security and MIR is a security, but also making some, I think, quite remarkable claims about, for example, Terra deceptively replicating Kai payments onto the Terra blockchain, arranging for secret bailouts in relation to UST's depegging, despite publicly saying that it was the algorithm itself, okay? Soliciting investors in capital raise, despite saying that it's decentralized, directing funds into personally controlled wallets for operation, including Bitcoin Fund Reserve that was supposed to hold up the UST peg, okay? Really only having a use case of UST for use in Anchor protocol, and facilitating arrangements with other entities to artificially prop up demand. So this is a perfect example of some of these asymmetries, that if there isn't a regulatory framework around this, then we have scenarios where investors can be hurt because of the fundamental asymmetries between the promoters of an enterprise, the builders of the enterprise, and the investors in the enterprise. So where do we go for this? Well, this is where it gets tricky, the regulatory path forward. Some suggest that at best, when you're dealing with new technologies, this is Chris Brummer and Yisha Deve's paper in Georgetown Law Journal, which is quite a well-known paper in fintech scholarship. You're seeking stability, you're seeking clear rules, and you want to encourage innovation, and at best, you're going to get 2 out of 3. This is the tension, and this is the challenge with the regulators. Is it, at what points are we getting out? Whether or not this empirically holds seems to have some strong data behind it. Maybe we can find a balance between all of these things, but it's a fundamental challenge that regulators are continually having to work through. There's a host of constant concerns that regulators are looking at where there could be asymmetries in the market. This is just scan, for example, of ones that I talk about in my recent report to the to the Public Order Emergency Commission. Now, in addition, we have complexities, for example, within particularized crypto innovation. So I recently published a paper on at the Canadian Business Law Journal on the regulatory perimeter for fiat-backed stablecoins, so like USDC and USDT. In that paper, I identified kind of an intersecting, overlapping risk analysis and assessed not just the jurisdictional ramifications of stablecoins, i.e. who should regulate them, but also the consequences if they're only regulated under securities. And I made the argument that that's not actually an optimal framework, because if they're even though if you make the argument that they are securities, there's still functions of stablecoins that they get used in consumer payments functions that actually having systemic risk regulators, payment regulators, Bank of Canada, for example, would actually make more sense for certain functionality of it. Well, in that paper, I set out a cross-sectional analysis of the various risks. Now, you'll notice, obviously, I've highlighted something in red here. USDC, which was, I would argue, fairly widely considered to be the most stable of the fiat-backed stablecoins. There has long been concerns about the sufficiency or the adequacy of reserves of Tether. The USDC being more open with respect to its sufficiency of reserves, suffered a major depegging event when SVB, Silicon Valley Bank, became insolvent. Why was that? Well, $3.3 billion of the reserves that were underpinning the USD stablecoin all of a sudden were held at SVB, and there was market uncertainty as to whether or not SVB would be able to honor those claims. It immediately depegged. So under what I describe as the issue of reserve custodian insolvency, it immediately depegged when the FDIC and the Fed comes forward and said, well, we will honor depositor claims above the 250,000 FDIC limit, immediately repegs again. But this is a good example of kind of the complexity of applying regulatory parameters to particular innovations, is that it's not just one risk, it's a whole host of risks. And in many cases, it's not just one regulator. It's potential applications to securities regulators. And in this case, this would be in relation to prudential regulators. Regulators have also a challenge, and historically it has been the case, which is why you haven't seen a lot of regulatory movement to date with respect to DeFi. When it comes to DeFi, it's not certain which courts and law even apply in many cases. Okay, one could argue quite reasonably that open programmable public blockchains actually have no regulator truly in charge. Now, the regulators are always going to be at a continual data and informational deficit and a gap between the technology and the innovation that they have and what the market has. There's also concerns about replication. So in addition to there not being clear jurisdiction, the largely anonymous nature of it, the fact that enforcement is challenging and there's copycats and there's redress. So what do you do with it? That is something that regulators, I think, globally are honestly struggling with. That can be challenging for builders in the space. And I'm very well aware of the challenges that builders do. Legitimate builders in the space and I have many friends in this category, legitimate builders who don't fit into that slide that I showed with all the nefarious actors, who have legitimate utility use cases, and they're wanting to test it, and they're not sure exactly whether or not by testing their particular use case, it's going to offset certain laws. So this is where the regulator and the industry has a relationship potentially, and I have hope, particularly in this country, because I've seen a lot of positive things. The use of sandboxes, for example, the use of discretionary relief, the sandboxes and innovation hubs that are popping up across a number of potential segments, both in securities jurisdiction, but outside of securities jurisdiction as well. The ability to look at something within certain parameters, provide time-sensitive relief, still facilitate supervision and testing. I think that these are positive things, because ultimately, in order to maximize the utility for any new technology, we have to have a testing environment where it can work. And much of regulation is kind of a pendulum based. When we think about the things that have happened in 2022, we go back to that slide, when we look at Celsius and we look at Terra and we look at FTX and we look at some of these other ones, we think, well, let's just throw the full gamut of regulatory controls and parameters on it. Well, as I mentioned here, I don't think that's even possible, to be honest with you, particularly in DeFi. And if we do that, we run the risk of deterring legitimate builders and legitimate innovators from the space in building and actually creating products and services that could be beneficial to consumers. So I'm hopeful for the future. I think that the steps that have been taken by the regulator to date have been meaningful, and they have been justified, largely in relation to what we've seen and with respect to the way that retail investors are interfacing with markets. I do think, however, that there are some challenges going forward, largely with respect to DeFi and regulating things that don't look like conventional structures. It's relatively easy for the regulator to look at something like FTX and say, and hey, in Canada, we knew of, our entire regulatory policy formation was because of a mini FTX, not exactly the same, but Quadriga had elements of custodial and operational and risk management and governance risk that actually led to 21402 consultation paper and 21327 and 329 and everything that we have right now within respect to centralized crypto asset trading platforms. But we can look at FTX and we can say, that looks like something we've seen before, the regulators. Okay. But when we look at something like pure DeFi with direct self-custody interfacing, that doesn't look like something that we've historically seen, which does create a significant challenge. But I am hopeful given the mechanisms that the regulators are using today. Finally, I'll just throw in my last 20 seconds. The other challenge is the nature of information itself. This is a slide that I created for a presentation that I gave to the North American Securities Administrators on Terra. And in my experience, being deeply involved in the Terra run up and fall down from an academic perspective, how retail investors interfaced. I had somewhat dubious honor of having my papers the subject of various Reddit threads about Terra. And regulators are also having to deal with the challenge that investors, particularly retail, particularly young investors, are not using functional securities disclosures. They're influenced by social media, they're influenced by influencers. So this is another thing that regulators will have to deal with. And this is something I expect to see some movement on in the future. So time is out. I hope this was helpful. Good luck to the pitch individuals, and thank you for having me today.